Well, I know you've heard a Federal Reserve rate hike may be coming in the near future. We don't know when. And that has many experts nervous, not due to the hike itself, but how people are going to react. Because guess what? A lot of folks have never seen a rate hike, right? Well, joining me now to help explain is David Bach from Edelman Financial Services. We're going to talk about the possibility of a rate hike. You know, it almost doesn't matter when it comes. When was the last time that we had a massive change in policy?
It was 2004. So what's amazing, Gerri, is I think we've been talking about rate hikes since 2007. So it's literally been 7 years or 8 years of us talking about rates are coming up. I do believe, and we do believe, that by the end of this year, next year, we will see rate increases. And what that
by the end of this year?
By the end of this year.
Okay.
And I think what that really means for people at home and what we're doing for our clients is your portfolio has to be protected. So first we can talk about the portfolios, and then we can talk about from a shopping standpoint.
First, I want to show folks like what happens to the market and the impacts. And you've got some great information here to help us understand. So let's work through some of this. The last time we had a rate hike back in '94, there's a pullback in the S&P, right? You see this immediately. Bam, 8.9%. But then a year later, what happens?
Well, if you look at this, so 94, 97, 2004, the average pullback was roughly 9%. So you see an immediate pullback, and this is specifically in the stock market. But if you look at what happens within 12 months, you'll notice the markets recover. In fact, 1997, the market was up 39%. Ridiculous. The average recovery is 15%. So I think the real lesson here for investors is if the stock market takes a dip, just stay the course. Now, what this doesn't take into consideration, however, is the bond market. So, half of Americans don't even have money in the stock market. We've talked about this.
Yes.
What a lot of Americans have money in is in bonds. And so if your money is in bond funds, for example, that's where the markets get hit. So as rates go up,
what
bond
part
prices
of the market is going to get hit the most?
Very specifically, it's long duration bonds. So if you have bonds that are over 15 years, and many investors do, and you're sitting in anything that is high yield related over 15 years, 25 years,
it's really common.
That's what comes down because people have been chasing yield. So you've got to stop chasing yield right now. We've been taking our clients' portfolios and reducing it to a short-term duration. Below 10 years, you want super high quality, and I'm telling you, you don't want to wait.
Corporate or govies?
You need to have a little bit of, you need both, corporate and governments. What you don't want to be in is anything that is junk. So as we go into rates coming up, typically what we see is anything that's not high quality, has long duration, that's what comes down the fastest.
Now here's my fear, that people are not going to take your advice and they're going to get freaked out all over again. So many people in the bond market, not in stocks. And as you just saw from the numbers we showed, it's the stock market that's probably going to recover the quickest.
Well, and also many investors in the last 15 years know nothing but a bond bull market. They've never seen bonds not do well. So that bond markets recover too. I mean, really the lesson is always to stay the course. But if you're going to be proactive, now's the time to rebalance. And then on a retail standpoint, this is the time to be refinancing. You got that home that you've been waiting on. Don't wait any longer. If you're going to buy a house, now is the time to be buying. And I will tell you this, if you're going to buy a car and borrow money, which we don't recommend, but if you are, right now rates are low and they're going to go higher.
Credit card interest rates.
Well, we don't want you to have credit cards, but the interest rates on credit cards can go higher too. Right now, interest rate on credit cards are very low, but those will go higher also.
I got to tell you, it's been a great world for people with debt because it didn't cost much. That's about to change.
It's about to change, but the good news, because there's always a silver lining, is that as rates go up, the interest rate on savings, checking, CDs, and short-term investments go higher too. So for those retirees desperate for some safe investments with higher yield, that helps when rates improve.
Great story, and well done, David Bach. Thank you so much for
Gerri,
coming on.
Thank you. Happy Friday.
Happy Friday to you.